In this video, we will explore the concept of technical analysis. This is a method used to evaluate securities, but it is quite different from the traditional research you might do on a company. Instead of looking at profit and loss statements, technical analysis focuses entirely on analyzing statistical trends gathered from trading activity. The primary data we look at are price and volume. The core concept here is that all relevant information, whether it is company news, economic factors, or market sentiment, is already reflected in the stock price. So, the goal is not to find the intrinsic value, but to forecast the direction and magnitude of future price movements. The people who practice this are often called technicians or chartists because they study patterns in historical market data to predict where the price is going next. To understand how this works, we need to look at the core assumptions that support this entire field. Think of these as the pillars of technical analysis. The first pillar is that price discounts everything. This means that anything that could possibly affect the stock, known or unknown, is already baked into the price. Therefore, we don't need to analyze the news, we just need to analyze the price. The second pillar is that price moves in trends. Markets do not move randomly, they move in identifiable directions, and once a trend is established, it is likely to continue. The third pillar is that history repeats itself. This happens because market behavior is driven by human psychology, which tends to be cyclical. We also believe that market action is predictable and that volume confirms price. If the price moves up, we want to see high trading volume to confirm that the move is real. We can visualize the dynamics of technical analysis as a triangle. At the top, we have history. We look at past prices because they provide indications of the underlying trend and its direction. On one side, we have volume. The trading activity accompanying a price movement gives us inputs on the underlying strength of that trend. If a price rises on low volume, it might be a trap. On the other side, we have time. This is the span over which price and volume carry the impact of long-term factors. At the center of this triangle is price behavior. Technical analysis integrates all these elements into price charts to understand if there is adequate buying interest to take prices up or selling interest to take them down. It is helpful to compare technical analysis versus fundamental analysis to see where they differ. Technical analysis is all about understanding price action and market behavior using historic price and volume data. It is best suited for short to medium term trading strategies using chart patterns and indicators. On the other hand, fundamental analysis tries to determine the intrinsic value of an asset. It uses financial statements and economic reports to make long-term investment decisions. While a fundamental analyst looks for undervalued assets based on cash flows, a technical analyst believes the price captures all info and focuses on forecasting where that price will move next. Now, let us look at two of the most famous concepts in this field, which are support and resistance. A trend strategy helps traders benefit by trading in line with the market, whether it is moving upward, downward, or sideways. Support is a price level where there is high buying interest, preventing the price from falling further. It acts like a floor. Resistance is a price level where there is high selling interest, preventing the price from rising further. It acts like a ceiling. If the price gets near resistance, holders often book profits because they expect the price to retract. However, if these levels are broken with strong volume, it is called a breakout. This indicates that the trend has accelerated. Remember the volume rule here. A trend must be supported by volume. A trend without volume is considered weak and might reverse. Technical analysts use different types of charts to visualize this data. The simplest one is the line chart. This chart uses closing prices over time and connects them as a continuous line. It is ideally suited for quick trend visualization and getting a long-term perspective of where a stock has been. However, it has a limitation. Because it only uses the closing price, it does not capture the intraday price movements. It leaves out the open, high and low prices of the day. So you miss the volatility that happened during trading hours. To see that missing detail, we use a bar chart, also known as an open, high, low close chart. As the name suggests, this chart shows the open, high, low and close prices for a given time period. It is visually represented by a vertical bar. The top of the bar is the high price and the bottom is the low. A small horizontal notch on the left indicates the opening price and a notch on the right indicates the closing price. This is best suited for detailed price action analysis and identifying volatility, as it highlights the full price range and the directional bias of the day. A more visual evolution of the bar chart is the candlestick chart. It is defined similar to bar charts but is visually much clearer. It uses rectangular bodies, often looking like candles, to show the open and close. If the close is higher than the open, the body is usually green or white. If the close is lower, it is red or black. Thin lines sticking out of the top and bottom are called wicks or shadows, representing the high and low. This chart is best suited for identifying market psychology and spotting patterns with names like doji, hammer and engulfing. The key feature is the easy identification and interpretation of trends via color. Moving to more advanced charts, we have the point and figure chart. This is unique because it focuses only on price movements and completely ignores time and volume. It uses columns of X's to represent rising prices and columns of O's to represent falling prices. A new X or O is only drawn if the price moves by a specific amount. This is widely used for identifying breakout levels and clear support or resistance zones. Its key feature is that it filters out the noise of minor time-based fluctuations, making it ideal for long-term trend analysis. Another chart that filters noise is the Renko chart. The name comes from the Japanese word for brick. This chart uses fixed price movements or bricks rather than time intervals. A new brick is created only when the price moves a certain amount. If the price stays flat, no new brick is drawn even if days pass. This is best suited for getting clarity on trends and momentum tracking. Its key feature is that it smoothens out minor fluctuations, which makes it very good for traders who use trailing stop strategies to protect their profits. Finally, we have the Heikin Ashi chart. This looks like a candlestick chart, but it is calculated differently. It uses adjusted candlesticks that average the price data to reduce noise. In a normal candlestick chart, a red candle can appear in an uptrend just because of one bad day. In Heikin Ashi, the formula smooths that out, keeping the candles green to show the overall trend is still up. This is ideal for trend following strategies due to its visual clarity. It helps the trader remain longer in the trade by filtering out whipsaws, which are sudden false reversals that often scare traders out of good positions. To wrap up, let us discuss the suitability and limitations of technical analysis. This approach is primarily suitable for short-term investors and traders. The reasoning is that business fundamentals seldom change drastically in the short run, so relying on price patterns is reliable. Traders often use tools like moving averages to reduce the impact of day-to-day fluctuations. However, there are limitations. It is less suitable for long-term investing. Why? Because over the long term, business fundamentals do change. A company can launch a new product or enter a new market, fundamentally changing its value. In such cases, past price trends become unreliable for understanding subsequent movements.